And joining us now to share clues about what investors can potentially expect in Q1 is Lawrence Golub. He is CEO of Golub Capital, a direct lender and private credit asset manager. It's great to have you on the show. Welcome. I do want to start with this report that you've put out that basically shows that private equity-backed companies, that they could potentially be signaling some pros and some cons as we do look to the public companies that are getting ready to report. So what are you seeing in terms of some of these key trends for Q1?
Thanks for having me, Morgan. Really glad to be here. So our report is based on the actual revenue and earnings growth from private equity-backed companies in the first 2 calendar months of each quarter. So it's not a projection, it's not a forecast, it's simply reporting on a statistically anonymized basis what's really going on or what did go on in the first 2 months. And we're seeing strong earnings from U.S. companies, PE-backed companies. Software, business-to-business software, wow, really knocking the cover off the ball, as it has continued to do over many quarters here, with productivity-enhancing investments really driving things there. Revenues up double digits, profits up almost mid-double digits. 25% for the quarter. I think we'll see that come through in public companies and in the business-to-business tech center, not the sort of AI stuff, which really isn't there yet in terms of the implementation side. I think you're hinting at an area where there is a lower rate of growth, which is on the consumer side and the consumer spending side.
Okay, so let's talk a little bit about that, because we've gotten some warnings, we've gotten some results in the last couple of weeks from a number of high-profile consumer-related companies, and the question's been raised: are these canaries in the coal mine? What are you seeing in your data?
Well, we lend to a wide range of consumer companies, and I'll tell you that in the consumer sector, different businesses are all over the place. I think one of the things we're seeing is an increasing amount of consumer resistance to price increases. And what we see in our data is a relatively lower rate of revenue growth in the past quarter, healthy profit growth, 4%. But if you dissect the data, car washes that are growing revenue by selling monthly plans that really are a high value proposition, doing better. Restaurants that keep having labor costs go up and are passing it through on pricing, they're doing okay on same-store sales. Traffic counts are struggling. And I think we may be seeing the beginnings of some real consumer resistance to passing along the cost increases.
What are we seeing in terms of healthcare? Because we know there have been some real high flyers, particularly in the pharma space and healthcare, when you think about the Eli Lillys of the world and some of these secular growth stories, but it's been much choppier or weaker in other parts of the sector.
Well, healthcare services is showing well. I think healthcare service businesses seem to be getting under control their cost structures, better scheduling, better utilization of labor, and we're seeing that through this report with some pretty healthy profit growth, almost 10% profit growth. I think when you get to the biotech sectors, you're much more driven by the flows of venture capital funding. In the pharmaceutical sector, you've got a big regulatory framework. I think as we look forward here in terms of healthcare services, one area there may be some surprises this quarter would be in the Change Healthcare hack. We saw a couple little glitches on that. I hope we won't see too many when public companies report.
Okay. One to keep an eye on, though. In terms of AA, we were just having this conversation with Dan Ives that he expects that this is going to be a very strong earnings season for big tech companies, for the hyperscalers, in part because maybe perhaps we're going to start to see this inflection in terms of AI investments being monetized. What are you seeing in your data?
Well, you got to keep in mind, I'm wearing a navy blue jacket. Dan Ives was wearing this gorgeous, I don't know where he got it thing. So you got to keep perspective on where we're coming from on this. I think overall productivity enhancing investment is going to be driving the U.S. economy for a long, long time. Costs are going up. Costs are going up because of deglobalization. Costs are going up because of inflation. And productivity driving investment, particularly in PE land, is where the owners are really pushing. It's going to be very interesting to see as we get this next generation of LLMs really where we're going to be able to find measurable productivity increases. That's really not something we're seeing so far. I mean, going back to our software businesses, the businesses we lend to, this is still adaptation 20 years into ERP. And so I'm very hopeful we'll see tremendous productivity growth over a long period of time from AI, but we're far away from seeing anything measurable in middle market companies that we deal with.